Excited for our next panel. If I could bring up Maxime, Nathaniel, Harley, Trisha, excuse me, from Unit 21, Taylor Peake, and of course, Georgina. I know that there she is. Come on up here. Right from the round table, right to the stage. So thank you.
Hello, and thank you for attending. I'm excited for this panel. My name is Maxime Seguineau. I'm the founding partner of Raido Capital. We're an expansion and growth stage investment firm focused on what I like to call the financial domain, which is a fancy way to say we invest in the technology powering this whole room. There's the tech and fintech. We focus on that. But this panel is really about the guests today and the panelists. We have here a panel of entrepreneurs who are at different stages in their journey. Some have been, very successful and have brought, their venture to a successful exit. And some are in the midst of building the next great success story. I wanted to start, before we let them introduce themselves, just draw attention to numbers when it comes to venture and growth investing, just to put things into perspective and to show you how exceptional these people are. Out of 4,400 startups funded in 2018, we need to go back a few years so we have all the data. Only 1.1% eventually made it to a Series D. Out of those, 240 were sold through an M&A exit, and only 57 are what is referred to as unicorns, so a valuation above $1 billion. So if you do the math, investing in pre-seed, startups is a negative edge game. Right? So you really need to know what you're doing, and mostly you need to bet on exceptional entrepreneurs. And this is what this panel is all about, is to talk to founders as to what it takes from a product market fit or achieving that, commercializing your idea, getting it off the ground, thinking about your human capital decisions along the way, and also your financial decisions, right? How do you raise capital? Who do you raise it from? And when do you decide to sell if the right opportunity comes along? And again, just to put things in perspective as to how hard it is, and then I'll let them introduce themselves. Out of about 50% of fintechs that are generating below $25 million in annualized revenue are growing at less than 25% a year. That's why the success numbers are so low. Right? And I'm, again, not saying this to discourage everyone, but just to show you how hard it is and how necessary it is to continue funding the winners to make sure that we have an innovation economy and that the financial services sector thrives. But with no further ado, I'm going to go through the panel and let everyone introduce themselves, and would love also to hear, very briefly how you got started and what's the story behind that.
Great. I can kick us off. I'm Trisha, founder and CEO of Unit 21. We do AML and anti-fraud software for financial services. So we work with fintech companies, crypto companies, banks, sponsor banks to help them identify, investigate, and report suspicious activity. And previous to this, I worked at the online lending company, Affirm. I was very lucky to be very early there and built a lot of the original risk systems. And at the time when we started, I remember fintech people used to put their hands up in the air with quotes and say, "Oh, fintech, it's this new thing." And so, for me, this was a big bet that the economy is going to get more digital, and fintech is going to become far more mainstream. So that's why we started the company, because we felt like there is a big opportunity here, and the problem space of fighting crime and identifying people who commit child pornography, terrorism financing, things like that really resonated with me.
Cool. Hi, everybody. I'm Nathaniel Harley, co-founder of MANTL and currently the Chief Revenue Officer at Occupi. So we actually got our start by building a direct-to-consumer neobank about 9 years ago. Quickly realized that business model was really tough and got really passionate about helping the existing community institutions modernize and grow their institutions. And so pivoted the company into an enterprise software company overnight, and then MANTL was born. And so today, we basically deliver a suite of digital banking products that help the community institutions, credit unions, community banks modernize and become more efficient so that they can compete with the Chimes of the world, but also the money center banks, so that they can hopefully be around for many, many years to come.
Hi, everyone. Thank you for being here today. My name is Peake. Our company is called Occupi. We focus on payments in affordable housing, and so both navigating state-by-state compliance that each of our real estate partners are having to deal with for their buildings and properties in each state, building that into our platform, collecting payments based on those communities' rules, the rules of that particular state, and then we accept cash wallet payments, so Chime, Cash App, SoFi, Venmo, PayPal, as well as the more traditional methods, and then we pipe those payments into their property management software. My background is in software engineering, and I also own some affordable housing real estate properties myself, and so that's really how we came into this space.
Hi, everyone. I'm Georgina. I'm the founder of Solo. We are a collaborative data collection and sharing network for banks and fintechs. I started my career as a data scientist, originally in cybersecurity, and Solo is my second company. My first company was in lending, got really frustrated with not having a single source of truth we could pull data from that was explainable, where I knew how all the data was sourced. And realized across the industry we were all doing the same work, asking the customer the same questions, paying the same vendors to do a lot of repeat work. And so Solo was born.
Great, thank you. So, Georgina, let's talk a little bit about product market fit. So presumably everyone on this panel has achieved some form of product market fit. I don't think you're at that super early stage where you're still trying to figure it out. What was the key inflection point that helped you move from concept to implementation and know that this was the area that you needed to focus on?
I think for B2B, it's, my last company was a B2C company. And that was one where we reached a certain point and it became really obvious almost overnight when we hit product market fit. We would release a new feature and by lunchtime the next day, you would see, because of the high velocity, 40,000 people are using the product, what works and what doesn't work. With B2B, I think it's been a way, it's just not as linear in terms of like product market fit. I think I remember when it felt like product market fit, but I don't think it's as obvious when you're selling into the enterprise. I think for us, the moments that have felt like the most amount of product market fit have been where, and it's different per product. We now have 2 products. One of them felt a lot more like an enterprise trajectory, and I think our data sharing network, it was very much like a couple of weeks, and a lot of banks started joining at a very fast pace, which is not like banks. So I think I don't know how to answer this question in a non-linear way, because I think for the industry that we're in, banks take time. It takes time to realize that something is working, but at the same time, I think when the pain is not just there, but quantifiable and urgent, you feel everything. It doesn't feel like you're pushing. It just feels like you're reacting to a lot of momentum. And I think things start to break. And I think when things start to break is when you realize it's working. We doubled our team size in a very short amount of time, tripled our revenue, and it got to like 100 million profiles within a couple of months of launching the network. I think that is like true product market fit versus, I think, enterprise technology. The sales cycles are long. It can be very easy to like not understand if there's product market fit in a way that I think consumer companies don't really deal with, because it's much higher numbers and a much bigger sample size.
And Taylor, it sounds like you'd identified a very clear pain point. What was the validation to assume that you had product market fit, or are you still trying to, tweak it or figure it out along the way right now?
I would say we knew from the very beginning who our customer was, and we knew what those pain points were, mostly from lived experience in the space. So if you're navigating, operating those real estate communities, you really understand what that is. What we're still learning every day, and frankly what's still changing very rapidly, is how state laws and state rules impact those communities and ultimately impact the residents too. And so we understand what the communities need and how they're supporting residents, especially residents in underserved markets, but the landscape of that is constantly shifting. And so both the compliance and regulatory requirements on our side can shift from state to state, and that the communities are having to comply with. And then the needs of the residents stays more consistent in the sense that they're, in some cases just making the choice that they want to use these cash wallets as their primary bank account, and that they want to change the way that they're making payments, sometimes month to month, based on where they're receiving their funds from. And so keeping up with how the financial market is changing for the residents that we serve, but also the changing regulatory environment for the actual real estate community owners, operators, and property managers that we serve is definitely a changing landscape.
Thank you. And Nathaniel, I think looking at your own trajectory, I mean, you're still leading growth right now, but going back to MANTL, obviously there is a playbook as to how you grow your logos.
Yeah.
And a lot of companies are on that journey. Can you walk us through what is the blueprint, at least how you navigated it?
Yeah, for sure. And just to echo Georgina's point, I think as a B2B company selling fintech, it's challenging, right? And especially when you're selling into the existing incumbents, it's a long sales cycle business, long product build, long implementation. So the feedback loop is really, really slow, right? It's actually, and me and Trisha were talking about this, before we got on stage, why a lot of companies start with fintechs, because the feedback cycle is actually a lot faster, right? And the sales cycle is a lot faster. For us, we were entering a market at the time that had both existing players, so Meridian Link, Bottom Line, existing account opening players, but also a lot of greenfield opportunities where less than, I think it was about 20% of the market had our product today. And so for us, the first sign of product market fit was obviously signing our first customer, but then launching that product and seeing amazing outcomes from that product. So we were able to essentially improve conversion rates, reduce fraud, increase funding amounts, increase automation when replacing that legacy system. So that was sort of number one for us. We then built our next phase of growth off the back of one customer and one reference to get to the next 5 and 10. To me, the next sort of indication was our customers wanted to start to invest in us. So we started to raise some venture capital. We went out for a Series A. We raised from a firm called Point72, which is no longer in existence in what they used to do. But we had our bank partners wanting to invest in us and sort of buying into the validation. So that was huge. Obviously then, right, I would say getting your first customer is the hardest. Number 2 and 3 are the next hardest. And it slowly starts to become easier and easier and easier. When you start to have those early partners adopt your additional products, that is also really strong validation that what you are doing is working. And so when I think about our trajectory, it actually is more of a linear growth story, because you sort of go from 1 to 3 to 10 to 20, and now we're adding over 50 customers a year. But given the long sales cycle dynamics and implementation dynamics, the ability to sort of have that exponential growth that you see maybe when selling into fintechs or being a direct-to-consumer is a bit more challenging. So it's very much a picks and shovels business, and you gotta take time to get it right.
Yeah, and when we talk about capital, I want to go back to this: your customers wanting to invest in you, and how to think about that. Trisha, product market fit, and what do you look for in your business to identify whether or not you should go for it, or you still have to tweak and do micro pivots along the way?
Yeah, I think personally for me, the life of a founder, you're constantly thinking of where should you take the business. And one of the things that I found really useful was to look at, if you get a no, what is the quality of the no? So when we started the company, we actually started as an AML services company. We said, we'll do everything for you. We'll be the humans, we'll do the software. And people just said no and never responded to our emails. And then we said, okay, you know what? Why don't we just focus on the software, because folks already have teams. And we said, okay, we'll just do the software. And then we still got a bunch of no's, because we sell to risk and compliance people who are very naturally, obviously risk averse for a reason. And, but they would say, oh, no, because you don't have a customer yet. And for us, the quality of the no was really important. If it's because you don't have a customer, that means they're actually interested and want more market proof point. If it's no, because this is not interesting to me, that means that there's no real demand. And as we continue to release, at this point, we have 8 products now. And that's a constant thing that we're looking at. What is, if we get a no, what is the quality of the no? And of course, ideally you want all of the green marks on the board.
Yeah, and I like to say there's no more formidable competitor than do nothing. So let's talk about how you build teams and how you think about human capital. Obviously, probably the most important decisions you have to make along the way is who you bring on, obviously as your co-founders, if you have co-founders, and then how you scale that team and get people to think like owners, because you really need that at that stage. I know because I've done it. So can you talk to us, Trisha, about how you've thought about adding to the team? Obviously, you're also dealing with scarce resources at the beginning, at least. Walk us through your thinking and what advice you might have for folks.
Yeah, there were 2 major learnings for me. The first is equity. If you want someone to act like an owner, make them an owner. Like, you can't just, give regular cash compensation and expect that they're going to burn the midnight oil all the time. And obviously, at some point of the company, it's not really scalable, right? You can't give like 1% of the company when you're 100 people. But in the beginning, if that's not a lever, then why should someone build a company with you? So that was a really important learning. And actually, a lot of people we talked to felt like we were giving a lot of equity and were really generous. But I'm really happy with the decision, and I think it was the right decision. The second was many mistakes I've made was around hiring, where we would think so much about product decisions, customers, strategy, but around hiring, it would be like grabbing a cup of coffee, where you go to the interview and you're like, so tell me about yourself, and what did you work on for the last 5 years? And then everyone asks the same questions because there's no real structure. And once we started becoming more methodical about hiring, our quality of hiring improved, mostly because we knew what we were looking for and were more thoughtful about what the role that we wanted this individual to accomplish.
Very helpful. Nate?
Yeah, so for us, I think there's a few things. So obviously when we got started, raised, very little capital, and so me and my co-founder were basically doing everything, right? Product engineering, answering support tickets, out in the field, doing demos, sales, et cetera, and running just a very, very lean team. I think one of the benefits of that is you start to deeply learn every part of the business, and you're on the front lines, and you get to talk to customers and try to shorten that feedback loop as much as possible. Now, obviously, that's not scalable, right? So ultimately, you have to figure out how to scale the team. We probably went through what I would call like 3 phases of transition of our team over the sort of 9-year period, where the team that got us from 0 to 10 million of ARR, and then 10 to 20 million, and then 20 million to where we are today, had to be turned over every 2 to 3 years. And so that's a very challenging thing to do, obviously, especially as you build relationships and you obviously want to keep as many people at the company as possible. And so I think setting the right expectations from the beginning is really important. Also, and I'm sure you guys have heard this saying, but like culture eats strategy for lunch, right? Culture, in my mind, the people you hire are the #1 most important thing. Having intense alignment around a shared mission and vision and cultural anchor points is more important than anything. And we were always able to anchor back to what our culture was and really hired specifically for that culture, right? We would turn down people that from a resume perspective had insane experience and we had no business hiring, but we didn't feel like it was the right culture fit. But I would say that learning didn't happen at the beginning, right? That came through the trials and tribulations of having to rebuild the team, call it 3 times. And sort of thinking about where our team is today, it's one of the tightest executive teams that I've been a part of. And I think the reason for that is we really doubled down on the cultural aspect and making sure that, when we brought someone new into the group, everyone was a strong yes. Trisha talked about hiring practices. I think, if you can hire slowly and fire quickly, but really make sure like you are handling it at the top of the funnel and everyone's pounding the table for people to bring in, it will just save you a lot of time and money in the long run. So, that for us, along with talent density and just sort of focusing on having better, smarter, fewer people rather than, tons of people, which is really ultimately paid off for us at the end.
Completely agree with many points that he made. I think for us, for me and my co-founders, starting from the beginning with a very lean team and understanding all of the aspects of the business made it a lot easier when we were going through interviews of hiring other engineers and understanding like we've been in this role. We know what this looks like. We know what we're looking for and asking the right questions and getting those feedback. Also, just being willing to say this is not the right fit at an early stage because the time and the growth is so important that when you've brought on a role and you're like, this isn't working out, is being willing to like make that decision really quickly. And then from a cultural perspective, I think what we need often is very specific, or we're looking for something that feels like a unicorn, someone that has payments experience or compliance experience, and also preferably that has worked with a real estate software company. And so looking for that obviously means that we're looking for remote talent. When we were raising funds, I actually had a call with an investor, and he was like, "Where are you calling in from?" And I said, "Birmingham, Alabama." And he laughed and said, "Why? Why would you live there? That sounds like a horrible choice. I'm not sure about your judgment."
Look at the rent price.
And I was like, well, we did only raise 81 million, not billion, but million in venture capital across our entire state last year. So, I mean, I feel like it's only can go up from here. And he was like, this is not helping. But to my point is you really, when you're looking for remote talent and when you're looking to meet engineers or whichever role you may be looking for across the country, it's really looking for who's the right fit, who has the experience that you're looking for, who's going to buy into your team and your culture. And one of the roundtables today, we were talking about FBO accounts, and I had the opportunity to meet several attorneys that works for banks in the space or that works with fintech companies, and being able to also find consultants and attorneys that can help you navigate specific challenges when you're like, well, we can't bring someone in full time, or we can't find this talent that we can bring in at the early stage of a company, but we have really fantastic resources that we can reach out to and say, hey, we're experiencing this specific challenge. How can you help us navigate it? It's really great to have both full-time team members that you can find, as well as those consultants, attorneys, whatever the case may be, that you can plug in and reach out to when you're navigating a specific challenge in your business.
I think that our approach has been kind of finding the right balance between, I think no one knows the company and how it's built better than the founder. And I think seeing other people in the industry hire, like what I've worked with recruiters in the past where they're like, okay, like their ex insert brand name of someone that's done data sharing before. And we'll hire them based off of resume, and those have been actually like the worst hires I've made, because just because someone looks good on paper and like maybe has the experience on paper of someone that has done something kind of like this does not mean that it will always work out. So we've always found that the right balance has been first principles, like we are a data sharing company that is built the same way that like Palantir is built. It's like we've built it on cybersecurity principles. And so even if this person is like ex-Stripe and Stripe has really, really great tech, fundamentally they've already come with some sort of bias on how data sharing should work. And so that experience might not be totally relevant to like how our company is built. And so trying to kind of remove the labels and the resumes and think from a first principles perspective of like what feels right for Solo based on decisions we've made for our company, even if it maybe doesn't make sense to an investor, why you have a bunch of data scientists and ex-cybersecurity people building a credit bureau, it makes sense for us, and that's how we've decided to build it. So I think a mix of, we have ex-cyber people on the team building data sharing, but also we have like a former chief risk officer who also was at the CFPB. And having the mix of people that would use your product or from the industry, but also complete outsiders that are thinking about the problem from more of a first principles perspective and true to like how you're building, I think that mix has really worked for us.
I didn't know. I'm dying to ask this question to whoever wants to take it. Does big company person work well in the 0 to 5 million in ARR context?
No.
No.
Well, it depends. I found one person that it's worked well. I would say 99% of the time it's hard, right?
Yeah.
Because there's a lot of infrastructure and support you get at bigger companies that you just don't have at a startup, right? And so you need to be able to roll your sleeves up and get your hands dirty, and that's not a mentality that all people have.
Yeah, no, I usually advise founders not to do that because the odds are really slim. So let's talk a little bit, Georgina, about your financial capital strategy. We just went through human capital. How did you go about capitalizing your business and getting started and meeting the first bills when nothing's coming in? And at this stage now, like, what are the different steps that you've taken to capitalize the business to fulfill your vision?
So I actually bootstrapped the company until we got to our first paying customer, which I was very fortunate to be able to do because I sold my last company. And as we were taking capital on, I think everyone talks about like value add investors. Actually, Nathaniel was one of the first people I talked to when we were fundraising, so kind of full circle. And I remember at the time we had 2 term sheets from very different funds. And one of the funds was, who our current investors are, Bank Tech Ventures. I'm not sure Wayne is here. But the decision that I made was around like who can bring us to the next stage of product market fit, which, Bank Tech Ventures is a consortium of over 100 community and regional banks. I think I made a really good choice going with Bank Tech Ventures. I think when your investors are also like the market and customers, just being able to obviously for business development purposes, have like a very strong pipeline that's kind of built for you, like it's yours to lose pretty much. And the second element is also just having like me being a complete outsider to banking. I'm not a banker, I'm a data scientist. Our team, we don't have a single banker on the team. Having bankers on speed dial, like CEOs on speed dial, being able to ask if this makes sense, is this grounded in reality, have really hard conversations when we're making strategic decisions, has been a good balance. Again, talking about like a team that's complete outsiders, building from first principles, and then having that as like a contrast. I think similar to how you hire for what you're not good at, you also should think of capital partners in the same way. Like, what am I missing, and how do you find capital partners that complement either from a network perspective or skill or industry perspective. But it also obviously helps a lot when your investors are customers.
Taylor?
I would say that we stumbled into a wonderful thing. I would love to say it was very strategic and we had outlined this, but in reality, it happened a little differently. So we also bootstrapped our company until we got our first customer. And then after we got our first customer, we raised approximately $1 million in private checks very quickly. And they were strategic private investors who were wonderful. And I was committed to, we're just going to finish our seed round with private investors. And one of our investors was really pushing me for the same reasons, was really pushing me to, you really should reach out to some VC groups that are in the space that have either are in the same industry, could be customers in the market, and raise capital from VCs. And that was really frustrating advice. No, I'm kidding. And it ended up great. But it was a new kind of environment for us because we had not started the process of reaching out to VCs. We had just been focused on private checks. And so we started reaching out to VCs and really trying to navigate who is interested in us, who are we interested in, who is going to be great partners. And we landed with a fintech, kind of intersection of fintech and regulatory VC, also a VC that's a corporate investor that's in the same space selling to the same customers as we are, that was really complementary, as well as two social impact VCs that also had both fintech and real estate teams that they were working with. And so it was just a great fit for us to have those different perspectives in the industry and to be able to really lean on their expertise as we're growing. And so it was a wonderful fit, but going from the perspective of what private investors are looking for that have real estate portfolios to what VCs are looking for and their expectations coming into the space was jarring and very different, and took a while to like get our footing, but I feel like we landed in a great space. We closed our seed round earlier this year and are now looking to, if we are going to raise another round or if we are going to look more at debt financing as we grow into cash flow break even. And so we're really excited about kind of how that's developing, what we're looking at from funding perspectives moving forward. But I feel like we landed in a great spot, but I can't say that we built a strategy and it was just a straight shot. We were like, oh, this is going to be a perfect fit and these are the right strategic partners for us. We just kind of stumbled through that process, I would say accurately, but that landed in a great spot.
Nathaniel?
Yeah, so we had a not always up into the right journey as it goes. But so if I were to take 3 learnings from our fundraising, really to me, it's number one, choose the partner, right? Like you're entering into a relationship, a long-term relationship, and so having comfort with the partner at the fund is really, really, really important and will pay dividends in the future. Number 2, work with a fund that has dry powder set aside to support your next round, right? Because who knows where you'll be in that next time, and you want to do that. And then, number 3, our strategy was always raise, smaller amounts of capital at increasingly higher valuations more frequently, which, keeps the bar a little bit lower and allows us to continue to execute on what we're doing. So, we got into Techstars as this direct-to-consumer company that sort of launched a small friends and family round. We raised $300K as our initial round. I was coming off of selling a business in the media space at the time, so very small exit, so didn't have enough capital to go self-fund it. But went through Techstars, found an investor to lead our seed round, ended up pivoting from this direct-to-consumer company into MANTL, which was a B2B enterprise software company. Go back to the point around picking the partner. They were very, very supportive, ultimately supported the journey we were going on. Ended up raising a Series A from Point72, started to bring in some of our customers, did a follow-on with Point72, and then raised a very large Series B from Capital G, which is Google's growth fund. The other thing that I learned along the way was a lot of investors don't understand or buy into selling into the bank market. And trying to convince them or get them there is very, very hard. So we sort of disqualified people very early and focused our time and effort on those investors who had a similar thesis and felt bullish on the space, because we didn't need to explain the TAM to them and the opportunity that ultimately we wanted to go after. So that was really helpful. And then at the end of the day, investors invest on points on a line, right? Keeping a sort of touch point, keeping a drip of information going so they can see your traction. All of that is really, really important. It's the number one thing I advise, all the companies that I invest in, have frequent every 3 to 6 month conversations, just sort of casual get to know you, because ultimately you're building a relationship and you're establishing that trust. And that's really important. So that was sort of our venture-backed history. We raised about $86 million all in. We were then going out to raise a Series C at the end of last year. 2024 was our best year ever. We had 5 term sheets, and then all of a sudden Alchemy came along and put an offer in front of us that was very attractive. We were certainly not planning to sell the company. We felt very bullish on the future of the company and where we could take it. But I was talking to one of our advisors, and he said something to me that really resonated. He was like, look, you could be 80% sure that you're going to go hit this 5-year plan that you're putting in front of these Series C investors. But what you can control is, where's the market going to be in 5 years, right? Multiples were at 10, 11 times when we were doing it back in a year ago. Now they're at 5 times, right? So you could literally double the business and still be at the same valuation. Number 2, at sort of the valuation points we were getting to, which was above, call it 400 or 500 million, you limit your options, right? You're really talking about, the number of buyers that can acquire you are very few. So you're talking about going public. Now being part of a public company, I'm like, why would anybody do that? But it's certainly one option. And then number 2, like selling to private equity, which don't pay high multiples. So ultimately for us, while we weren't looking to sell, we felt like it was the right decision and home for the business and the right outcome for our investors. And now gave us the opportunity to sort of jump 9 years in the future and continue to build and deliver on the mission of ultimately why we started MANTL.
Thank you. And yeah, I'll say no one's ever gone broke for selling too early. And then also 90% of business plans pitched actually don't meet their targets over a 5-year plan. That's something you learned as an investor. Trisha, what about your fundraising journey?
Yeah, we've raised $92 million since we started the company. And my main learning is actually similar to yours, where fundraising is like high school dating. You're trying to get interest but not be very desperate. You back channel to see if the other party's interested, and both parties are doing that. And it's really fascinating. It's a really interesting social experiment. But I think the biggest learning is, the classic, absolutely cheesy advice of, when you want to go find your spouse, you should first love yourself. And I think it's really important that your business is actually doing well. And if your business is doing well, almost nothing matters. People will want to.
Yeah, no, I would agree with that. I know we're coming up on time. Before we get to parting thoughts, are there any questions in the audience or anyone who'd like to ask the panelists? Okay. So parting thoughts. What are the key takeaways? I mean, I know, again, you are all at different points in your journey, and we have to be relatively brief here, but I wanted to get sort of like your main takeaways. You've given some on the financial side just recently, but broadly speaking, the experience itself of starting a business. First of all, my first question will be to part is, if you knew it, would you have done it? If you knew how hard it was? Nate, do you want to take that?
Yeah, I mean, for sure, right?
Yeah.
Like 100% yes. I mean, with the hindsight, would I have started this exact business? I don't know, maybe I would have started OpenAI or something like that. But I think generally speaking, it was a good decision. Look, to me, as I was saying, like, these journeys are not always up and to the right? They're very difficult, and so leading with transparency, leading with accountability for your team is really, really important. And then focusing on talent density and culture, to me, that's what makes the recipe for success. There are a million ideas out there. There are a lot of great ideas, but at the end of the day, it comes down to execution, and the way you execute is through people and the people you hire.
And Trisha, do you feel fulfilled throughout the journey? I know it's probably up and down, but
I don't think happiness is the goal, but fulfillment maybe.
I did use fulfillment. I didn't use happiness. Yeah.
Fulfillment, yeah. I'll have to think about it. But I do think one of the things, we had spoken about it after you sold, that you were like, oh, I feel like I've aged 10 years. And I feel like that too. It's a really, like, people talk a lot about the early days and how hard it is, but after we started, we demoed to a bunch of companies, and there were 5 copycats who started. So we have 5 competitors. I mean, I think we have 20, and then 15 died, and the 5 were still somewhat around. So there's always a new challenge that you didn't anticipate that hasn't been talked about, but it is a type 2 fun, as they say.
It is harder than what people say it is. That's my takeaway. Well, thank you to all 4 of you for this great conversation. I really appreciate you guys making it, and it's been a wonderful experience just to hear you guys talk about your journey, and thank you to the audience for your participation today.